Welcome to This Explainer. Today, we're diving into a massive, honestly mind-bending paradox. The Pakistani banking sector is pulling in record-breaking profits right in the middle of severe economic turmoil. While the broader economy is seriously struggling, this one specific industry is experiencing an absolute boom. So how exactly is this happening? Let's break it all down.
Okay, let's get right into the central mystery here. How is it even possible that a sector making up just 2 or 3% of the total economy is seeing this kind of astronomical growth? When a whole country is facing inflation and really tough times, you'd naturally expect its banks to feel the pinch, right? But nope. Instead, they're thriving like never before. To really wrap our heads around the sheer scale of this, we need to look at some numbers.
Just to give you a little context, let's talk about the global AI giant, NVIDIA. Over a 3-year period, NVIDIA saw a 10x stock return. Their stock shot up from around $20 to nearly $200. Now that makes total sense, doesn't it? They're literally fueling a worldwide tech revolution, powering everything from self-driving cars to the AI that probably helped write your last email.
But here's the shocker. Local commercial banks in Pakistan, take UBL for example, have matched that exact same 10x growth over the exact same period. Just think about that for a second. They haven't invented any world-changing artificial intelligence. They definitely haven't revolutionized global data processing. And yet, their stock returns are perfectly mirroring the biggest tech boom of our entire generation.
Actually, it gets even crazier. The Bank of Punjab hit a staggering 12x return, which instantly begs the question, who or what is fueling these massive profits? Because if it isn't groundbreaking innovation, what exactly is the engine driving all this wealth?
Well, to figure that out, we need to peel back the first layer, the conventional playbook.
It all starts with a foundational concept you might have heard of, fractional reserve banking. Basically, this is an accounting system where banks hold on to just a tiny fraction of customer deposits in reserve, let's say roughly 10%. Then they loan out all the rest. So, when you deposit your hard-earned $100,000, the bank holds on to $10,000 and loans out $90,000 to someone else. When that $90,000 makes its way back into the banking system, they keep 10% of that and loan out the rest again. They are essentially multiplying physical deposits into massive pools of digital air money to lend out.
Now, where does all that multiplied money actually go? You'd probably assume banks exist to lend to everyday people and local businesses, right? Well, the advance-to-deposit ratio paints a very different picture. It turns out that only 35% of deposits actually make it to the private sector. The vast majority of the money is handed straight over to the government as a giant risk-free loan. Why bother taking a risk on lending to 100,000 small businesses when you can just safely lend billions to the government all at once?
And that brings us to how they actually make their cash, the spread. Think of this as the ultimate middleman's commission. It is simply the difference between the interest rate a bank pays you, the depositor, let's say 8%, and the rate it charges borrowers, which might be around 14%. By lending safely to the government and expanding this spread, banks are locking in massive profit margins with virtually zero risk. Over the last few years, this spread has skyrocketed, effectively doubling their overall profits.
So that's the conventional side. Let's move on to layer 2, the Islamic banking paradox. Now, we definitely have to look at both sides of the debate here impartially. Critics of the current model often point out that Islamic banks use the exact same interbank benchmarks, like KIBOR, as conventional banks. The argument goes that while the terminology changes to things like expected profit rates, the actual numbers perfectly mirror conventional fixed interest rates. So when the central bank hikes up rates, the profit rates at Islamic banks mysteriously jump up right alongside them. Conversely, esteemed scholars and architects of this system, like Mufti Taqi Usmani, firmly defend the structure. They argue that applying the correct, Sharia-compliant contractual structures fundamentally changes the nature of the transaction entirely. He uses a really compelling analogy. He says the physical acts in a legal marriage and an illicit relationship might look similar from the outside, but the underlying contract, the rules, and the responsibilities make one permissible and the other forbidden. In other words, the legal structure changes the very essence of the transaction. However, if we look objectively at the actual data breakdown, a fascinating reality emerges. The core Islamic ideal of pure profit and loss sharing, which is known as musharaka, only accounts for about 28% of operations. Another ideal model, mudaraba, isn't even large enough to get its own category in the state bank's bulletin. The vast majority of operations actually rely on trade-based models, and in practice, these models largely shield the bank from taking on any real financial risk alongside the depositor. Furthermore, to really maximize that spread we talked about earlier, There's been a huge, aggressive push to convert savings accounts into current accounts. Why? Well, because current accounts yield absolutely zero return for the depositor. A single premier Islamic bank added a staggering 240 billion rupees in a single quarter to these free current accounts. The bank takes this free money, lends it out at those high government rates, and pockets 100% of the profit. So if you're sitting on a zero-return current account, you are literally providing the free fuel for this massive profit engine.
But all these numbers have real-world consequences. That brings us to layer 3, the human cost.
You see, to hit these wildly aggressive deposit targets, especially that desperate push for zero-cost current accounts, bank branch employees are being pushed right to the absolute brink. Staff on the ground are trapped in a deeply toxic work culture. We're talking 60 to 70-hour work weeks, late-night check-in calls from upper management, and extreme relentless pressure to hit sales numbers. Medical professionals are even reporting significant spikes in employee anxiety, depression, and severe health crises like heart attacks that are directly linked to this intense workplace stress.
And you better believe this pressure trickles right down to the consumer. It leads directly to the aggressive selling of highly profitable but honestly toxic products like bank insurance or bank insurance. The structure of these products is incredibly punishing for the buyer. Vulnerable depositors often lose up to 70% of their investment to hidden commissions in the very first year alone. By year 2, another 20% is lost to fees. This means it takes an everyday customer 6 to 7 years just to break even on their own money.
And this completely highlights the stark, glaring inequality at the very heart of this paradox. While branch staff are suffering through 70-hour weeks and everyday depositors are getting squeezed by inflation and hidden fees, the executives at the very top are reaping unbelievable rewards. Annual bank president salaries have reached astonishing heights. We're talking executives taking home anywhere from 33 to 80 crore rupees a single year.
So, how are people reacting to all of this? Let's look at Layer 4, the crypto rebellion.
History actually shows us that entirely different, equitable systems are completely possible. Did you know the discovery of the Geniza documents back in 1896 proved that an equitable, interest-free financial system thrived in the Middle East for over 300 years? During the Fatimid and Ayyubid eras, capital flowed freely, bankruptcies were handled by the community, and there was no systemic exploitation. It proves, for sure, that a different way of doing things isn't just some utopian dream. It has real, concrete historical precedent.
But today, everyday citizens aren't waiting around for traditional banks to reform. And they aren't just looking back at history either. They're taking matters into their own hands. Think about this. Since 1947, so over 78 years, the traditional banking sector managed to open roughly 90 million accounts. But in just a few short years recently, Pakistanis have opened an estimated 30 million cryptocurrency accounts. That is an absolute explosion of adoption completely outside the traditional system.
This massive shift towards crypto, it's not just a speculative investment strategy. It is a direct, ideological rejection of centralized authority. As Satoshi Nakamoto laid out in the foundational vision for Bitcoin, the root problem with conventional systems is the requirement of trust. You have to trust that central banks won't debase the currency. You have to trust that commercial banks won't exploit your deposits. The huge move to decentralized ledgers is essentially a demand for total transparency and mathematical certainty over blind trust.
I want to leave you with this final thought. At the end of the day, a bank is not just a fancy vault or a slick mobile app. It's fundamentally an institution built entirely on public trust. So, as a whole new generation wakes up to the mechanics of fractional reserves and massive profit spreads, and as they increasingly demand fairness, transparency, and decentralization, what happens to these institutions? Can the traditional banking sector survive its own crisis of trust? Thanks for exploring this explainer with me today, and as always, keep questioning the systems around you.